Welcome to all of you. We have never done such an initiative like this before, but we thought that 2016 shows a good opportunity for long-term investing in equities. Uh, this because such an opportunity presents itself only once in many years, we thought that we should do an event where we are able to actually explain the rationale to customers by doing such an event. The current market fall has been a good opportunity, and the reason for the market fall has nothing to do with India. As you all know, oil has corrected substantially in the last 1 year and 3 months. And the reason why the markets have been correcting is due to non-fundamental reasons. That means reasons unconnected to India. That is the reason why people have been selling. To give you an analogy, it is like if someone had a big expenditure that they had to do in their family, like whether it is on education or marriage or something like that, people would have had to sell stocks because to meet that expenditure. And at that point of time, what the fundamentals of the stocks are not material. We are in that kind of a situation where people have been selling for reasons not connected to the fundamentals of the country or the company. So, one of the questions people have been asking me periodically is that whenever FIs sell, what should one do? The most important thing what we have learned by looking at the past data is that whenever FIs sell, that is a time for you to actually be very careful in stock market trading. And it is the year actually for long-term investors in products like mutual funds. There have been 4 years where due to again each year was a global reason. 1998 was Asian financial crisis, 2002 was the internet bubble bursting, 2008 was the global financial crisis, 2011 was European crisis. In each of the crises, FIs sold for non-fundamental reasons, and in the next 1 year, the returns have been good. Each time the non-fundamental selling has happened, the next 1 year prospects have been good. So like that, we believe that 2016 is the year to invest in equity for a medium-term perspective, and we believe that opportunity exists at this point of time. You know, when we meet foreigners, people ask us why they like India. While India has a high population, it has been proved that wherever the population growth continues and where the working age population, that means people entering the workforce around 20, at the age of 20, goes up, those are the countries where the markets do well. And where the country's population declines, like to give you an example, like Japan, these are the kind of countries where markets don't do well, which is one of the reasons India is one of the best markets for which people think of for the long term. If you, the other reason why people like India is that the macroeconomic situation of India is has improved substantially. The fiscal deficit has come down substantially, the current account deficit has come down substantially, the consumer price inflation has come down substantially, and this number is also just because of products like pulses. As you all know, crude oil has come down and even interest rates have come down. So we have one of the best macros in most of the emerging markets at this point of time. So what do we want investors to do in 2016 is consider adding to their equity allocation if they have invested in equities, or investing in equity now if they have not invested. One of the challenges which exists for people who invest in equities is the time to invest in equities is when you have market volatility, and when your past returns are bad. And if these two are there for you, that is about the time to invest in equities. And as you would have seen, we have high market volatility at this point of time. The returns are bad in the last 1 year. So this is a good time to add to your equity position, because equities is an asset class where you invest when things are bad and take out money when things are good. If you go back to the year 2007 and 2008, in 2007 everything was looking good, but that was one of the worst years to invest in equity. In 2008 everything was looking bad, but that was one of the best years to invest in equity. So that is the reason why I would say that when you have bad data, bad information, bad sentiment, that is a time to actually add to equity assets. So one of the most important things which we have been focused on, and I think one of the things that investors should realize and is that the longer the period that investors have invested, the better has been the return in equity, and the lower is the volatility. This is a statement which Warren Buffett also makes periodically, that you have to invest in the long term in equities, because that is possibly the best way to consider investing in equities. Because in short periods of time, like what you would have seen in the last 6 months, the volatility is high and returns can even be negative. But if you have invested for a very long period, you definitely see lower volatility, and the experience of investors in equities have always been decent, which is what this slide shows. So what we think, based on whatever we believe is the way to invest in equities, is to do a systematic investment plan. We think that that is one of the best ways to start investing in equities. A systematic investment plan, particularly in a product like tax plan, where there are specific schemes which are approved as per the Income Tax Act, is possibly the first product to invest in equity, because you get tax concessions on your investment in these products. We also believe that people should invest in equities when market is low and falling, and we believe that one of the ways to look at investing for the long term is through products like dynamic asset allocation funds, because those kind of products lead to very good investor experience over the long run, and in a volatile asset class like equities. So we think that dynamic asset allocation funds is a very interesting category. It is a category where what the fund does is actually buys when the market falls, it sells when the market is higher. And as Warren Buffett says, the most important thing is how you handle your emotion to make money in equities. And this actually keeps the emotion aside, because it tries to sell when the market is higher. So it sells in a year like 2014 second half, or 2015 first half, and buys into the periods like what we have seen in the last 6 months. So that is so that what this goal of the dynamic asset allocation fund is to reduce the impact of market volatility, and market volatility can never be avoided. So this is broadly the approach that we actually like for investing, and I personally am of the view that 2016 would be one of the years where, if you are able to add to your equity position, you could have a very pleasant experience. In my investing career, I found that the best times to invest is when there is a poor sentiment in the equity market, and we believe that the current sentiment in the current year has been pretty negative for equities, giving rise to an opportunity for all of you for long-term investment. Long-term investment, that too when the market is volatile and when the market is down, is possibly one of the finest ways to consider investing in equities. Given that framework, we believe that long-term investing equity is the way to go, and times like 2016, through the year, through products like systematic investment plan and systematic transfer plan, is possibly a very good way to consider investing in equities. If you are considering lump sum, products like the dynamic asset allocation funds are the products to consider.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.